Welcome back. Time now for our ETF Spotlight. Today we're taking a look at the banks' financial earnings season kicking off. The group as a whole is higher with the overall market. Wilfred Frost has more details for us back at HQ. Wilfred.
Good morning, Sarah. So bank stocks up a couple of percent, as you said, after earnings from JPMorgan and Wells Fargo were not worse than feared. And while that's encouraging, JPMorgan CEO Jamie Dimon made clear that they, like everyone else, are uncertain of the outlook from here.
This is such a dramatic change of events. So there are no models that have dealt with, GDP's down 40%, unemployment growing this rapidly. And that's one part. There are also no models that have ever dealt with a government which is doing a PPP program, which might be $350 billion, it might be $550 billion. Unemployment where, it looks like 30 or 40% of the people going on unemployment look higher income than before they went on unemployment. So what does that mean for credit card or something like that? Or that the government's just going to make direct payments to people. So this is all in the works right now. The company's in very good shape. We can serve our clients. And we're going to give you more detail on this, but it's happening as we speak. And I think people are making too much of a mistake trying to model it. When we get to the end of the second quarter, we'll know exactly what happened in the second quarter.
Dimon also addressed potential reopening of the economy. He said, hopefully, will be sooner rather than later, but it won't be May. We're talking about June, July, August, something like that. If we look at the XLF year to date, you can see roughly halfway between the highs and lows of 2020. We're up 1.7% still, Sarah. In fact, Wells Fargo and JPMorgan have both just turned negative over the course of the call. Comments from Charlie Scharf at the top of the Wells Fargo call, which I call echoed similar tones to Jamie Dimon there, i.e. Huge number of provisions, i.e. potential bad loans coming right forward, but that they perhaps haven't peaked yet and they'll continue to have to take provisions in the quarters ahead.
Wilf, on that note, actually, I was looking as well at a quick transcription of some of Scharf's comments because they've begun, as you know, at around the top of the hour. They had their commercial clients draw down about $80 billion from existing credits, obviously. That's the revolvers that we hear so much about that corporate America has been taking down. That's a pretty big number, utilizing $80 billion of their loan commitments. He also went on to say, I think, that ATM transactions were down about 17% in March and credit card purchase volumes down 13% from the fourth quarter. And again, like Jamie Dimon reiterating, we're just in a world right now that we haven't seen before.
Yeah, exactly right, David, and his comments in terms of that unpredictability of where we are. He says we don't know how quickly the economy will recover when these orders are lifted, but we also don't know the impact of this government response, i.e. The scale of it overall. I just want to bring back one point, David, in terms of these loan loss provisions and whether they're going to get worse from here. So if we look at the total amount of reserves against the total amount of loans for each of the banks, JPMorgan's went up 90 basis points this quarter. Now 2.3% of the total loans are provided against. Wells Fargo's only went up 10 basis points to 1.2%. But either way, when we think of the scale of what the economy is facing, if you're talking only 1% or 2% is provided against so far, no matter how good the quality of the loans is they made in the first place, it does feel like there's some worse potential to come if things don't reopen quickly and these government programs don't work perfectly.